Why different currencies have different values. Money makes the world go round, but not all money is created equal. A US dollar, a Japanese yen, and a Pakistani rupee may all represent value, yet they hold drastically different purchasing power. Why is that? Why does one country's currency buy more and another's buy less? The answer lies in a fascinating web of economics, psychology, and global politics. A system shaped by centuries of trade, trust, and national policy. Let's dive into the real reasons why currencies differ in value, and how this system affects everything from your cost of living to the price of your next vacation abroad. What a currency's value actually means. At its core, a currency's value reflects what it can buy, both domestically and internationally. But when economists talk about exchange rates, they usually mean how much one unit of a currency is worth compared to another. When global investors and governments have confidence in a nation's stability, economy, and institutions, they buy that country's currency, increasing its demand and therefore its value. On the other hand, if investors fear inflation, political instability, or economic mismanagement, they'll sell off that currency, causing its value to fall. This trust factor is why the US dollar dominates global trade. The United States has a stable government, a huge economy, and deep liquid financial markets. Even when things get chaotic worldwide, investors often rush toward dollars, treating it as a haven. In contrast, countries with unstable politics, corruption, or weak central banks often see their currencies lose value because investors don't trust them to maintain long-term stability. The role of inflation and interest rates. Two major forces directly shape currency value: inflation and interest rates. A. Inflation. When inflation is high, each unit of currency buys less. People lose confidence, prices rise, and foreign investors demand more compensation for holding assets in that currency. As a result, the currency's value drops. For instance, if a country prints money recklessly, like Zimbabwe or Venezuela did, inflation can spiral out of control. People stop trusting the currency altogether, leading to hyperinflation and total collapse of value. B. Interest rates. Higher interest rates make a currency more attractive. Investors can earn more by holding assets, like bonds, in that currency, so they buy more of it, pushing the value up. This is why when central banks like the Federal Reserve or the European Central Bank raise rates, their currencies often strengthen. When they lower rates, currencies tend to weaken as investors look elsewhere for better returns. Balance of trade, exports versus imports. Another crucial factor is a country's balance of trade, the difference between what it exports and imports. When a nation exports more than it imports, foreign buyers must purchase its currency to pay for those goods. This boosts demand and raises the currency's value. One reason its dollar is among the strongest in Asia. However, this isn't always straightforward. The United States, despite having enormous debt, maintains a strong dollar because of its unique global role. The dollar is used for international trade, oil pricing, and as the world's reserve currency. Investors know that no matter how much debt America carries, the demand for dollars will remain high. Political stability and governance. Politics can move currencies as much as economics. Investors watch elections, policy shifts, and government behavior closely. A country with strong institutions, the rule of law, and predictable policies tends to have a stable currency. But in nations where governments fall frequently, corruption runs rampant, or leaders interfere with central banks, the currency often tumbles. For example, sudden coups, sanctions, or policy uncertainty, like abrupt nationalizations or bans on foreign investment, can trigger instant capital flight and a rapid drop in currency value. Speculation and market psychology. Central banks and currency control. Most major currencies today are free-floating, meaning their value is determined by market forces. However, many governments still intervene through their central banks to manage or stabilize exchange rates. For example, China often steps in to keep the yuan's value lower to make its exports cheaper and more competitive abroad. Switzerland, on the other hand, has intervened at times to prevent its franc from becoming too strong and hurting its exporters. This kind of currency management is part of a broader economic strategy, but it's a delicate balancing act. Too much intervention can backfire, draining reserves or creating global trade tension. This reserve hierarchy means that global trust and usage perpetuate the strength of certain currencies, a kind of monetary gravity that keeps them at the top. PPP helps economists assess whether a currency is undervalued or overvalued relative to its true domestic purchasing strength. Historical context, from gold to fiat. To truly understand why currencies differ today, you need a glimpse into history. Before the 1970s, most currencies were tied to gold under the Bretton Woods system. Every dollar represented a fixed amount of gold, and other currencies pegged their rates to the dollar. Since then, currency values have floated freely, shaped by markets, policy, and speculation. This flexibility allows countries to adjust to shocks, but it also means currencies can swing wildly depending on perception and confidence. The global ripple effect. The value of currencies affects global trade, investment, and living standards in profound ways. A strong currency makes imports cheaper, but exports less competitive. A very weak currency helps exporters but raises costs for consumers. Tourism, debt repayments, and even migration patterns are shaped by currency shifts. For developing nations, a weakening currency can spark inflation and reduce access to foreign capital. For rich countries, it can change where companies choose to build factories or outsource work. Currencies, in essence, are the heartbeat of the global economy, pulsing with every policy move, market rumor, or trade imbalance. The future of currency values. In the future, digital currencies and geopolitics may reshape this landscape entirely. Central bank digital currencies, CBDCs, like China's digital yuan, could change how countries manage and trade currencies. At the same time, shifts in global power, such as the rise of Asia, the decline of Western dominance, or the fragmentation of trade blocs, might redefine which currencies hold the most sway. Different currencies have different values because each nation stands on a unique foundation of economic performance, political stability, and global credibility. The dollar reigns supreme because the world trusts it. The yen holds firm because of Japan's discipline. The rupee or peso may fluctuate because investors still gauge their future with caution. In the end, money is not just paper or pixels, it's belief. The worth of a currency is the world's collective vote of confidence in a country's future. And that, more than any formula or policy, explains why the numbers on your currency exchange screen never stop moving.